must give you a little disclaimer. I can't advise you onto what you need to be picking for investments. My job is just solely to provide the information, just to give you the awareness of what is out there. And then it's up to you to decide where you go from there. Okay, so, our beginner's guide to investing is going to give you loads of great insights. What we're going to talk about what is investing and the reasons why people do invest and why you might want to invest if you haven't started already. We'll get you thinking about what to consider when building your financial plan. We're going to look at the different investment options and the different levels of risk that comes with them, and how you can get started with investing and what is involved. And then following on today's session, if you would like the opportunity to talk through your finances, you can book in a financial health check. So the same QR code we've been sharing throughout the week, you'll gain access to that as well. Okay, so the first question there, what is investing? So it's a way to set aside money today so that you can use in the future. Unlike with a savings account, there aren't any guarantees, okay? But your money could still potentially grow more over time compared to what is in your savings account, particularly those with a low interest rates. Okay, so they do differ from savings, is that the investing carries an element of risk to your investments, which we will talk about shortly. If you are saving in a savings account now, then the amount that you put in now will never go down, and the total savings balance will increase as interest is added. You will also get the benefit of compound interest, which is when the interest is then earning interest by itself. Okay, it's going to keep earning interest on interest on interest. But one of the downsides to savings in a traditional savings account is that the money that you have in there will be reduced due to inflation. Okay, as I said before, the inflation rate or the interest rate that you receive on your savings account doesn't always keep up with the inflation rate. Okay, right now is okay, but in the past couple of years, the inflation rate was about 12%, and the typical interest you were receiving on your savings was about 1% at one stage. So the money in your savings were losing its purchasing power. Okay, but with investments, it does involve purchasing assets that don't have a fixed value, and they can both rise and fall in value over time. So this means that your money could reduce in value, but some people feel that investing may not be for them, maybe because of the risk involved in losing money. But which is why when investing your money, it is important to know that it is usually best for a person to have a healthy level of savings, okay, particularly your emergency fund, before you do consider any investments. Okay, so that will lead us on to our next slide here. Okay, so we've looked at what investing is all about and some of the options available. So once you know your day-to-day finances are in order, okay, you've already saved for your short-term and your medium-term goals and are well prepared for any financial emergencies, you may decide to include investments to help you in the longer term. Okay, so starting small could be a good way to dip your toe into the water. Then you can watch what happens to your investments and invest more later on if you want to do so. And when it comes to how you can set up your investments, it's important to consider whether you would like to take advice or whether you feel like you can set up investments on your own. All right, so there are a couple of ways you can invest. One option, of course, is DIY. So doing it by yourself, you can use online platforms. This would involve doing your own research, finding an investment that works for you. At this point, you might want to research, do your search online for, just type in something in Google, such as top 10 investment platforms. And there's going to be a lot to choose from. So by doing your own research, you can compare the different providers that are out there, looking at things like, easy account setup through the articles that they offer, the fees that you would pay for for this way of investing, will usually be the least, as you are not choosing to take any form of advice. Okay, you're simply selecting the investments of your own. But at the same time, it does mean that if there was any mistakes that you have made, you don't necessarily have a right to claim any compensation, because you are choosing the products completely by yourself. So it is totally on your head. Okay. An alternative option is to get started is if you feel like you don't feel confident enough to choose investments on your own, then of course you can seek financial advice. Okay. You can seek some form of financial advice. There are two ways you can do this. One of them, I think we touched on it yesterday, was the robo advice or the robo service. So this is offered on several investment platforms, and you would basically complete a questionnaire that will assess what level of risk you are most comfortable with. Okay, whether it's low, medium, or high risk investments. You would then be allocated your risk profile, and then the platform would then suggest a ready-made basket of investments suitable for you. Okay, so they're going to be managed for you on an ongoing basis. These will be managed by a fund manager. In addition to the fees would pay for investing, there may be an advice fee as well when it comes to taking robo advice. But they are a really good middle ground between you choosing investments on your own and also getting that advice service. Okay, so if you are thinking about doing this, you can have a look online again, typing in top 10 robo advisors, to get a selection of the different investment platforms. When you are looking around, check for things like easy account setup, help the ones that are going to help you with your goal planning, ones that of course have security features, and of course getting that great customer service as well. So if there was anything you were unsure about, you can speak to someone and then they can clear things up for you. Okay. Of course there are going to be fees with this, which will be slightly more than if you were to do the DIY option. But also check your own bank's website as well. Whoever you bank with, they're going to have a robo advice platform. So usually one of the tabs at the top will say investments, and then they can choose a suitable basket of investments for you. Okay, and then the other one is the advice from a financial advisor. So there are two types here. You've got the restricted advisors, which you would find in the banks, and then you have the independent financial advisors. Okay, both would come at a cost. Typically, the independent advisors will cost more, but the difference between these two types is the independent advisors will give you a wider range of products and product providers that are on the market. So you will have, you should get the best service possible with the IFAs because they're exposed to, everything else in the market. Whereas the restricted advisors, typically they're only going to show you what they can offer you in terms of their own banks, their own banking products, or other companies that they're linked with. So for example, you might have one bank that's linked with, Allianz, for example, or Legal & General. They're doing business with them, but IFAs will have the whole market. Okay, so it may cost more, but you will get the best service. Okay, so but the most important thing is doing your own research, regardless whether you're doing advice yourself or doing a robo advice or getting the robo advice or speaking to a financial advisor, doing plenty of research, and also only investing what you do not need within the next 5 years. Okay, because there's going to be a lot of fluctuations in the market. There is also that misconception, I guess it happens, what people tend to promote online on social media and YouTube and things like that. Sometimes they make it appear as though investments is a get-rich-quick scheme, but that's not always the case. Well, it's almost never the case. Okay, it's going to take time. But when it comes to investments as well, there is of course risk, but as it says there's no such thing as a no-risk investment. Okay, so as we've said, an investment is putting money aside today that you can use in the longer term. Again, there's no guarantees with anything, unlike with a savings account. But an investment could give your money more potential to increase in value over time. Okay, so they can go down, but they can go up as well, and it's up to you. Obviously, the first thing you need to do is identify what your risk tolerance is. Do you consider yourself to be a low risk taker, medium, or high risk taker? Okay, so moving on to the following slides now. So building your financial plan. So ideally, as I said, only invest money that you don't need in the next 5 years. The reasons for this is because the markets will cause your investments to rise and fall in value. So you do need sufficient time to ride out the peaks and the troughs. Okay, so before jumping into your investment journey, you want to make sure you have that good understanding of your financial situation and think about your financial plan. To do this, again, I mentioned it in previous webinars. Important to look at your budget because it's the first step to take control of your overall finances. So thinking about what you have in your emergency fund. So having between 3 to 6 months worth of living expenses there first, then knowing what you want to achieve in the short, medium and long term. So short term might be Christmas presents, etc. Then your medium to long term. So this is where investments will come in. So medium term, we're talking roughly around 5 years. So it might be buying a house, it might be a wedding, for example. And then the long term could potentially be the same things, but of course your retirement planning as well. Okay, so it is less risky if investments are held for a longer period. Okay, so as I mentioned, typically 5 years or more. Of course, some investments are less risky than others. I'm going to discuss this one in the following slide. But life is filled with lots of different needs and aspirations. So the chances are that you have more than one goal that you would like to put your money towards. So think about what is going to work best for you. Okay, so and a good place to start is by working out how much you can afford to put away each month in each of these categories. And just have a look at that golden rule that we have at the bottom. Save for what is around the corner and invest for the future. So again, highlighting my point that it's not a get rich quick scheme. Think 5 to 10 years plus, 5, 10, 15, 20 years plus for your investments, but making sure you have the right savings accounts for the emergency short and the short term. So we spoke about the regular saver, fixed rate savers for the savings accounts for the first 1 to 2 years or so. Now, in terms of the different investment types out there, the different investment options, let's have a look. So there's no shortage of options that you can invest in, but there's also no need to feel overwhelmed as well. So to help you get started, we've got 4 different options here. So firstly, we do have funds. So funds are a ready-made basket of investments. When you are invested in funds, you're essentially buying into a mix of assets. These may include shares, it might include properties, government bonds and cash. And they save you from trying to pick individual investments that you think, might perform best. But the great thing about funds is that you're not putting all of your eggs into one basket. Okay, so instead your money goes to a range of different options. So I think I mentioned yesterday as well, you don't want to put all of your eggs into one basket when it comes to, investing. So you want to diversify your portfolio as much as possible, because if one of them don't perform well, then it's going to be balanced by the others that will be performing well. Okay, so when you are investing, it is important that you protect yourself from any silly mistakes and risks by having a diverse range of options to choose from. Okay, the next thing we have on the right hand side is the equities, stocks and shares. Okay, so basically these words are all used to describe owning a share in a particular company. So whenever you're buying shares, you're effectively buying a small stake in a company, and then the company will sell shares to raise money, which they then use to, expand their business. Now, if that company performs well, or maybe they're expected to perform well in the future, then demands for its shares will generally increase, which then is then going to push the share prices up. So let's say if the company does or is expected to do badly, then of course the share prices would then generally drop. Okay, so as a shareholder, the value of your investment rises and it does fall in line with the share price. So while the money you are investing has the potential to grow, it could also fall in value. So you may get back less than what you have originally invested. Okay, so then you have the stocks and shares ISA. So with this is a type of account you can choose to hold your funds or your shares to make them more tax efficient. So this means you won't pay any UK income tax or any capital gains tax on the returns that you're going to receive. Although there is a limit to how much you can put into an ISA each year. So, I think we touched on this as £20,000 a year. So when you are considering all of your options, keep in mind that you can spread this amount. You can spread it across, say, stocks and shares, or any other type of cash ISAs, but you must keep within that tax allowance of £20,000. But within all of them, stocks and shares is generally the investment one. But the good thing about this stocks and shares ISA as well is that you don't have to be an expert to set one of these up. There are accessible platforms out there that are going to do this for you. You can access this on your mobile phone, even explore your own banks, as I said before. For example, at HSBC, we provide articles as to how you can choose the right option for you and how to go about it. And then finally, the other platforms out there, there are many others out there. You've got properties, you've got collectibles, you've got arts and crafts, coins, antiques, even coffee, absolutely everything you can invest in. Of course, there has been popular ones in recent years, things like crypto. I imagine people might have questions about that. You have to be very careful with that one because it is a very volatile market. It's always a very high risk, basically. So you need to understand the different risks that comes with the different types of investment that you're choosing from. If you are prepared to take that risk, then, not just particularly crypto, but any type of investment, you need to understand what your risk tolerance is and also the money that you don't need within a particular period of time. With something like crypto, it's constantly going up and it's constantly going down. But if you're prepared to take a lower level of risk, then these ones that we have on the screen is probably the way to go about it, particularly if you've never started before, but you're willing to put some money aside. Have a look at these ones that we have on the screen here, and then just see how that performs over the next few years. And then if you're prepared to take some levels of risk, some increased levels of risk, that's when you can try, other types of investments that you've never tried before. Okay, but I would always recommend seeking financial advice before dipping your toe into a water that you've never tried before. Okay, so the final slide we're going to touch on today is the investment growth. Okay, so here is an example of, let's say you've invested £10,000 over a 5-year period. Okay, so this scenario is an estimate of future performance based on evidence from the past on how the value of these investment varies and also the current market conditions, but it's not an exact indicator. Okay, we're just showing you past performance. It doesn't mean it's going to be exactly the same in the future. Okay, because what you will get, it will vary depending on how the market performs and how long you are going to keep each of your investments. Okay, so you can see, there's different levels of risk, the different providers as well. So there are you've got the poor market conditions in the red. So let's say you've got the adventurous portfolio. As you can see, there is a potential to lose money. But you can see if it's performing well, the good market conditions in the grey, there's even more potential to earn even more compared to if you just left it in a traditional savings account. Okay, so if you left it in a traditional savings account, you're not going to lose money. You are going to earn interest, but you've only earned about £1,475. But if you pull it in something like an adventurous portfolio, you can earn just over £12,000. Okay, so have a look at other ones as well. Cautious, you can earn more as well. You can earn in the conservative portfolio £16,000. Balanced portfolio, which I guess a lot of people go for this one, is sort of medium risk, about £19,000, and then the £21,000 for the dynamic portfolio. So really important to understand all of this. Again, speaking to an advisor, speaking to the robo-advice customer service options will help you choose this. But again, the most important thing is only invest money that you don't need for that medium term. Okay, so a few top tips just to leave you with before we close off the session. So save up an emergency fund of 3 to 6 months worth of living costs before you invest. Think about starting small and watching your investment to see how it goes. If you are going to use your ISA allowance to invest, you are going to protect more of your money from tax, so anything up to £20,000. Again, be prepared not to touch your investment for at least 5 years. The longer, the better. So have that right balance between savings and investments. Consider taking advice to help you decide on what is right for you. Another point is keep calm. Short-term volatility is part and parcel of the investment journey. Okay, so just to add to that, whenever something is happening in the world, okay, whether that's, the war with Ukraine and Russia, or Brexit or COVID, there is going to be uncertainty in the market. Okay, but really important to, not just have that knee-jerk reaction of taking out money just because it's gone, your portfolio has gone down from, I don't know, £1,000 to £980 in one day. These things do happen. There is going to be fluctuations. It is normal. But as I said, the longer you invest for, the more potential for growth, and potentially even higher than what you would receive on your savings accounts. And to even minimize the risk even further, stay diversified. Diversification can help achieve any smoother ride. So remember what I said before, you might have, one particular investment that is operating at a loss, but then you might have others. You might have 9 or 10 others that are operating as a profit. So your overall portfolio is operating at a profit. And then invest regularly, despite any volatilities. Okay, so this goes back to having your budget. You might put a certain amount of money towards savings, and then you might put even as small as £5 or £10 towards different platforms. Okay, there are different platforms out there. For anyone thinking about DIY, you've got things like Trading 212, you've got Coinbase, you've got a whole heap of them out there. Okay, so again, we're not promoting them. They're not paying us to say this, just letting you know what is out there. Again, using the comparison sites to see the different list of platforms out there, which rate they charge. It's all going to be on there. The different profits that are going to be available. Have a look at Investopedia as well. I love that website. That one is like the Bible of everything to do with investments. So if there's anything else that you're unsure about, it is going to be highlighted on that website. Okay, so that was a very short presentation today. As I said, investments is always a funny one because, it's all about trying to find that balance between giving you information as well as not trying to provide advice, because again, I'm not an advisor. I can only provide that information. But if anybody wants to discuss things further on a one-to-one, you can scan the QR code. We can help you with investments, pensions, and any other financial topics. Okay, so I will end it there. So I'll hand back over to Debbie or Stephen just to go through any questions that we may have had.
Yeah,
right.
Thank you so much for that, Victor. That was a nice sort of intro into investing. I've got a question right off the jump. So when it comes to getting good advice, there are loads of people all over the place giving you advice, and sometimes they say we're not. But if you actually want to pay for advice, is there like with solicitors, you've got a firm of like a registry, and social workers have a registry where you can go and check that all these people are legitimate. Is there a list of where you can go and check if a financial advisor is actually legitimate, and therefore it gives you more confidence in trusting what they're saying?
Yeah, so the FCA website, so that stands for the Financial Conduct Authority. Okay, so if it's a firm of investment professionals, so even HSBC, we've got wealth advisors in our bank. So you're going to find HSBC on the FCA website. If it's an independent financial advisors, chances are you've probably never heard of them before, but their firm should be on the FCA website to let you know that they are regulated to give you advice. Okay, so just have a look at the FCA website.
Great stuff. Debs, you got anything to add?
No, I think there was a few questions in the Q&A.
Yes, I was going to get to them.
Do you want to read those ones? Thank you.
Yes, I'll read those ones. And I've unmuted the mics, so you can unmute, you can put your hands up, ask questions if you like, as we go along. So first question says, can you repeat which apps can be used to invest?
Loads of them. So you've got Trading 212, you have Coinbase, you've got obviously the bank you're with will have an investment platform on there. You've got, what else? Vanguard. You have Vanguard, you have Fidelity, you have Moneybox. It's only going to take one Google search, or use the comparison sites like Money Saving Expert. Absolutely everything, every different investment platforms will be shown on these comparison sites. Again, it will show you what they are charging. It will show you the level of risks that comes with investing in those type of platforms. So type in Google as well, top 10 robo advisors, and also type in top 10 DIY investment platforms, and then it will show you the best ones that you can choose from.
Great stuff. Thank you. Mark asks, anything you can share? Is there anything you can share about cost averaging with regular investing? Sorry.
Okay, that's like dollar cost averaging or pound cost averaging. So basically, if there is, even though the markets might be performing badly, it is still good to invest, even if the markets are low. Oftentimes, when the markets are low, that is often the best time to start investing. Okay, or the best time to start investing in a particular investment. Okay, so you might be investing £10 every single month, whether the prices are high or whether the prices are low. But if you are investing when that price is low, you are going to get more for your money. Okay, so again, it's not going to be overnight, but again, you're doing it for the medium to long term. So the chances are you are going to get a higher return if you're doing it for the longer period. Again, no guarantees, but basically what pound cost averaging is still investing the same amount or even more, even though the markets are in a downturn.
Okay. And if someone is new, most of us are new to investing, I guess that's why we're here. So when you say when markets are low, what does that mean? What am I looking at? How will I look at a stock and say that's a low price or that's a high price?
Okay, so when you're checking these platforms, let's say, I don't know, it could be anything, particular stock like Amazon, for example. It will show you how that stock has performed over the past, from when it first started. You can have a look at what the market price was the day before, a week before, a month before, 3 months before, and you can see how it's been performing. So you might, when you're looking at investments, people think of those graphs, right? That has all those squiggly lines, right? That goes up and down. So when the markets are low, then the line will be at the bottom. Okay, so when it's down at the bottom, that's when it's a good time to pull it in. But obviously, look at the information that you've seen from the previous months to show that, okay, it's been going up and down. Although it's down now, some people might be scared because they feel like they might lose more money. But again, it is going to pick back up over time. But again, it does take a lot of research, or if you're not sure where to start, this is where the investment professionals can come in. Just put your money in. It could be a standing order, £10 a month, and then leave it to the investment professionals to manage your portfolio for you. Okay?
Thank you for that. Is Bitcoin a viable option to invest in if you're new to investing? And where can you get advice about crypto investing? So that's two questions. So I'll repeat again. Is Bitcoin a viable option to invest in if you're new to investing? That's the first one. And then where can you get advice about crypto investing?
Yeah, I knew we always get questions about crypto. I knew that was going to come up. That's why I touched on it earlier. I thought, let me get there first before we get the question about it. Is it a good option to start with? Again, because I'm not an advisor, I can't tell you what you should and what you shouldn't do. But at the same time, if you've never done it before, if you've never invested anything before, personally, I wouldn't do that first. Okay, because it's so volatile. It is so volatile. I would say start with something that is less risky. Okay, so something like funds that we spoke about, basically letting the manager do it for you. But yeah, I don't know if anybody remembers the news that came out maybe a couple of years ago, and many people lost millions in crypto, hundreds of thousands of crypto, because it's so volatile. And at the same time, it's not regulated. It's not a regulated investment type. So again, I would say stick with the ones that is regulated, people that are watching. That's what I would say personally. I'm not saying you don't invest in crypto whatsoever, but it wouldn't be ones that I would say start with. In terms of where to get advice from it, I don't know, to be honest with you, because we don't like HSBC. We don't provide advice on crypto, to be honest with you. I don't think any of the major high street banks provide that. So where you're more likely to find advice on crypto would be, people on YouTube and social media, etc. But again, these are the people that make it seem like you're going to become a millionaire in one day. That's the thing. So you don't know how they sell you a dream that crypto and whatever is amazing, but they only talk to you about their wins. They don't tell you about their losses. That's the thing. So again, use the FCA website just to, if you do find someone that is sort of advising you on crypto, just double check that they are regulated by the FCA.
Thank you, Victor. Great. More questions in the Q&A. We've got, how important is it to review and rebalance your portfolio, and your thoughts on how regularly?
Okay, so what was the first bit of the question?
So the first question was, how important is it to review and rebalance your portfolio?
Okay, yeah, so very important to review it. How often to review it as well? The second part of that question.
Yes.
Review it. Okay, that's a good question. Review it from time to time. I'm not going to say review it every minute of every day. I wouldn't say review it every single minute of every day, because you're going to drive yourself crazy, especially when you see your portfolio, operating at a loss from time to time. Okay, just review it at least once a month just to see how it's performing. But even if it is operating at a loss, don't panic. All right, don't panic, because that is a very knee-jerk reaction, and you're only really going to be it's only really a loss if you take out the money while it's operating at that loss. Again, that's why I said doing it for the mid to long term, 5 years plus, 10 years plus, when you're ready to take it out. But don't review it every minute and then take it out because you're scared it's going to go down. No. Sometimes these platforms that I mentioned, Trading 212, Coinbase, sometimes if you haven't logged in for quite a period of time, it might just, unless you remember your password, that's when you're going to be allowed to go back in. So for example, I have Trading 212, and if I haven't logged in to that app for a month or so, or 2 months, and I try to log back in, it doesn't automatically log back in. I'll have to remember my password, and I prefer it being that way, because if I keep checking it every day and I see it's at a loss, I'm going to be panicking. But if I leave it for a period of time and I have a look after a month or 2 months, and I see, okay, this particular one, maybe Amazon might be operating at a loss, but then I might have Apple, that's on a profit. I might have Microsoft, that's on a profit. These little things. But when I check it, Amazon a month later, I would see it's now operating in a profit. It's going to keep going up and down, up and down, up and down. But in the long term, it does go up. So yeah, I'm not going to say just check it at least once a year as a bare minimum. At least maybe 3 to 6 months, maybe, okay. I would say. But don't drive yourself crazy by looking at it every 5 minutes, because I'm telling you, I used to do that when I first started, and then I realized, no, patience is key.
Thank you. Alice asks, what are the recommended robo-advisor platforms?
Okay, the top 10. So top robo platforms, you've got Vanguard. You've got Vanguard is one, like I say, the top of my head. Just Google search this one as well, I would say. It will tell you the top 10 performing ones. So Vanguard is definitely on that list. I think maybe Moneybox might be on there as well.
All right, great stuff. Cool. All right. Is there a ratio we can use when trying to diversify investments?
Is there a ratio you can use?
Yeah. So how much would you sow in cash, sow in bonds, sow in EFTs, sow in gold, coffee, in commodities? Is there a ratio that we can use to keep a nice balanced portfolio?
Yeah. So when you're using some of these platforms, you can copy other successful investors' ratios, for example. So Trading 212 is what I use, for example, and you might have loads of different investors on there that are sharing the different types of investments that they have. So they might have, 20% in equities. They might have 5% in properties, for example. So you can sort of copy their own ratios. But yeah, there isn't a sort of one size fits all. Everybody's you can choose your own ratios, basically. You can choose how much you choose to invest in certain platforms. Okay, so but to start with, you can sort of copy other successful people's one. So I've gone on there, people invested in things like Starbucks, McDonald's, gold, equities, absolutely everything. So I would say probably start there.
Okay, all right. So on all these apps, there is it like a community? So where the community is sharing their wins, their losses, etc., etc., and then you can copy that, or is it actual professionals who are putting on their I don't know, their picks?
It's a bit of both. It's a bit of both. So you can share it. If you were to do it today, you can sort of do it yourself. But again, the ones that have been performing the best tends to be the ones that you'll see at the top. Okay. And it will tell you how many people have copied their sort of their ratios as well. So the ones that you might see someone there where 50,000 people have copied their ratios. So, and then you just decide how much you're going to put to each of those investments as well. So some people have put hundreds and thousands of pounds in there. Other people have copied the same ratios, but they've only put maybe £100. But the level of profit in terms of percentage is pretty much still the same.
Okay. On that note, would you say fractional shares is a good idea, where you buy little bits of shares, or is it better to just try and get a whole share or shares?
Again, it just depends on the individual. It just depends on what you can afford to invest. As I said before, you want to diversify. So try and get as much as possible. So if one of them isn't performing well, the others are going to be performing. So try to diversify as much as possible, I would say.
Okay, great stuff. Would you recommend buying to let or investing in property, as there is a potential to get a bigger return on your investment?
So property investment is a popular one over the past few years, or like decades really. Buy to let over the past couple of years, I would say, has become less popular. I must admit, I'm not an expert in this area, but from what I've heard, buy to let is a lot of people are selling their buy to let properties. From the little things I've heard, people have been selling them because the mortgage prices and everything has gone up. A lot of people are selling their buy to lets, but typically property is a good, it's good investments. But I would say just do research on this is all I can say at this stage. That's what I can say. But properties in general, they have performed well, but buy to lets in particular, right now, a lot of people, hundreds, thousands of people are selling their buy to let. So I would say look in that area a bit more before going down that route.
This might sound like a silly question, but like when I think of property, I think of you're going to live in it or you're going to rent it out. But there are other property investments that you can invest in here. Like when they say commercial property, is that just like, I don't even know what that is. What is commercial property?
Commercial property is like, often it'll be when you're doing a business in there. Like you might be running a restaurant, for example. You might be opening a restaurant. Even your buildings, councils, like those will be commercial properties. So anything where business is operated.
So offices, shops,
offices,
Okay. Oh, like the Catford, what is it? That thing that's going on right now. Okay, yeah, I see what you mean.
Yeah, exactly. And then with residential properties, as you mentioned, you can live in it. Some people, well, you've taken out that mortgage for yourself to live in, but you might have a spare room, and then you might make extra income by renting out one of those rooms, right? So some people make money that way with properties as well. Some other people do things like Airbnb. They rent out the Airbnb. Some people rent out as a holiday home and things like that. But again, properties is not really my area to specialize in. But again, there is risk with all of it because, as I said, your mortgage rates might go up. Therefore, you have less profit. You can, of course, increase the rate of the rent, which is what a lot of them have been doing. But then you still put those renters at risk. A lot of them can't afford to keep up with those payments. So you might end up evicting them, but then suddenly you're struggling to find somebody else to take up that increase in rent. So there is risk with properties as well. But, again, it still depends on who you get to rent out those rooms. That's why a lot of them are opting in for, working professionals rather than maybe, I don't know, families, for example. Or some people, their market might be students. So just understanding the market before you going down that route.
Okay, cool. A couple more questions. Any educational tools on investing you can signpost to?
Educational tools on Investopedia. So as I said, yeah, that one is a good one. That's everything to do, any information you need about investing, from the history of investing to, the latest trends on investing, cryptocurrencies, you are going to find it on that one. So that would be a good one to start with.
Okay, great. All right. Can you? I'm not sure if this is an investment question, but I came up with this anyway. It said, can you explain the difference between APR and AER?
APR stands for annual percentage rate. So annual percentage rate is what will be charged to you if you have a form of lending, if it's mortgage, credit card, overdraft. So that's the level of rate. So if you have 19% APR on your credit card, that's how much is going to be charged to you every single month. Every single year, if you do not complete your if you don't repay back what you owe on that credit card in full. Okay, so let's say you've borrowed £100 on your credit card, but you fully repaid it back before your deadline, you're not going to be charged anything. Okay, however, if you've only paid £20, okay, and you're still owing money over the course of the year, then you are going to be charged that 19%. Okay, likewise with your overdraft as well, you might be charged 40% APR. On your mortgage, you might have a rate of 5% on your mortgage rates, so it will be 5% annual percentage rate. With AER, that is the interest you receive on your savings accounts. Okay, that stands for the annual equivalent rate. So you might have 3% being paid as interest into your savings. So that's the difference. APR is what is being charged to you, and then AER is money that's put into your savings account. Does that make sense?
Yes. And it just to clarify, it's yearly, not monthly.
Yearly.
It's yearly. So if you see 5%, that's what you're going to get for the year. If you're lucky, if you get 5%. All right, cool. Great stuff. Okay. The floor's open. Does anyone want to ask any questions or make any contributions? Because that's all that we have. I believe that's all that we have in the chat.
Can I ask a quick question?
Yeah, go ahead. No. That's Zoltan.
Yeah, it's a little bit about savings. Is it just, if you don't mind, is it better to have savings? Is it better when you have savings to have monthly or annual interest? I know it's not about investments.
So
going back to yesterday.
So the interest, the AER, which we've just touched on, so it might be 5% AER. However, the interest is going to be put into your savings account every single month, regardless.
Yeah, but don't they offer the option to have annual or monthly interest?
Oh, okay, I see. It depends on the type of savings account. So if it's something like a fixed rate, if it's like a fixed rate saver, no, it doesn't really make a difference, to be honest. I mean, the interest is calculated on a daily basis, to be honest, but I can't say it makes much of a difference whether you choose monthly or yearly. It just depends on your own needs.
Okay. But you don't get more over the year if you're getting it monthly or no. Okay.
No.
Just
okay. It's the same thing. Yeah.
Sure. Thanks.
Good question.
Lovely. Any other questions, anyone? No? Okay. Well, I think we've wrapped it up then. Thank you very much, Victor. That was so informative. We thank everyone for coming. Hopefully you will take all those beautiful nuggets and use them in your own life. And I hope everyone gets rich and makes lots of money.
Amen.
There is a life after Lucium, so who knows.
That's why we're here.
So yes, I think if there's no more questions, we thank you for coming and have a lovely weekend. And watch out, because the Professional Network have lots of things going on for next year. So just watch out for us, and we'll be in touch with you always. Take care, everyone. Thank you.